Depends what you mean by the problems that came with that. So there's a lot of work on the extent to which the problems that came with that were problems created by governments rather than the free operating of the money system. So I'm not sure what you mean by the problems that came with it. I think that it's likely that you would see certain commodities that have those characteristics emerge, but the whole point is that we don't know what would emerge.
There's a limited amount of, say, gold. Wouldn't that cause trouble in, for example, how much money people have, how much the gold would be worth?
I think there's a fallacy about whether or not you need a certain supply of money in order to act as money. In this regard, the quantity theory and monetarism. So I said that prices kind of don't all go up at the same time, but to some regard, most economists, Austrians included, would agree that at the end of the day, if you double the money supply, you're going to see a doubling of the price level. Okay, and it doesn't really make any difference, right, in that thought experiment in a hypothetical world, whether or not you do double the money supply. Okay, so in any country that's had a hyperinflation, they've tended to struck off the noughts. So I was in Romania in 2005, and when I arrived, you'd go to the cash point and you'd get several million lei, and you'd go out for dinner or buy a bottle of Coke or something, and it would be 2 million lei. And then whilst I was there, we woke up one day and you basically struck off 6 noughts. Okay, that doesn't create a massive recession. So similarly, it doesn't matter how much money you have in your supply, because all we care about is kind of fractions of that, and as long as that's a stable amount, then we can coordinate. As a business, you would choose what medium of exchange you are willing to accept, and therefore you would expect people to evolve into using the same thing, because it makes it a lot easier. But you would basically say, if Tesco wanted to issue their own currency and Sainsbury wanted to issue their own currency, you would, as a business, would choose whether you accept Sainsbury notes or Tesco notes. And if you have a £10 note from Tesco, you would choose whether or not you think that's worth £10. And it may be that if you have a note from a bank and there's concerns about the quality of that bank, then people will accept that below face value. But you would have a free choice as a business to say these are the private currencies that we would accept. One of the points is that you don't want all of the different competing currencies to have equal value, because we know that they have different value. We want consumers to kind of basically reveal what the value of those different currencies are. So what you want to do is to say, okay, because we trust this bank, this currency holds its value. If there's a bank that's over-issuing currency, then you want people to be able to say this currency isn't worth as much as this one, and that will probably mean that bank goes out of business, and that's why you expect good currencies to win out. What I'd encourage you to do is to treat the market for money, or certainly the market for banking, as similar to any other market, right? And so yes, it might be simpler if all toothpastes were the same, right? And there's legitimate arguments that say, what's the point in having 15 different types of peppermint toothpaste? It just creates confusion and stuff. We tend to think in most markets that proliferation of choices leads to a kind of a weeding out process that means that we end up with a relatively stable kind of menu of choices. But we need to go through that market process in order to get the good outcomes. So in the same way that we can kind of extend that argument to other things, say, wouldn't it be simpler if we just had this one thing or one price for everything? I think that kind of argument still applies. But there is certainly menu costs of inflation, and there's menu costs of inflation when you have a monopolized currency as well. But in the same way that the car industry is open to counterfeiting, and that people make fake cars and sell them, and when you get them home, it's actually made of wood or something, right? So again, we're going to say, okay, yes, there is this threat of counterfeiting. So what would we do as consumers that are concerned about counterfeiting? We're only going to accept notes from reputable banks, and the banks are going to invest heavily in convincing you as a customer that their notes are genuine. But then the point is that don't think that at the moment we live in a world where we don't have counterfeiting. It's just that the counterfeiter is the Bank of England. Right? In terms of exposure to other currencies, again, at the moment we have this problem where we have exposure to currencies. So if you're You know, if you live in certain countries, then you have that problem today. And really, we can kind of think about the medium step is really just saying, all that we're saying here is that people can choose whether or not they get paid in euros or whether they get paid in pounds or dollars or something. So to me, I think that would reduce the chance that you are exposed, because at the moment you have no choice about the currency that you're operating in. It happens that people think that the UK has a relatively stable currency, but I don't think it is relatively stable, because if you take any time period, the value of the pound has reduced significantly. So whether you look at the 70s or going back further, you know, the UK has had currency crises. It's not that we don't experience them. So I'm trying to liberate us from living under a failed currency regime so that we can live in one where we don't have to suffer the crises that we do currently suffer. The reason why I use a kind of a Soviet planning board analogy is the same thing as what's wrong with having people that decide on the price of shoes, right? It would sound ludicrous to have a committee that says we want the price of shoes to be this much, to be this much, and we're going to meet again in a month's time and see if we've changed our mind. When the problem is, because the Monetary Policy Committee does that, and it chooses a specific interest rate, which obviously has a big effect on all of these other interest rates in the economy. It's the same thing as trying to manipulate one market. And in actual fact, the interest rates that we tend to care about and that we're exposed to on a day-to-day basis, there is no single interest rate. There's millions and there's infinite different interest rates. And all of those interest rates are doing a job. They're trying to coordinate savers and borrowers. And if you kind of, as in with any other market, if you come in and you arbitrarily move the supply around to try and hit a certain price, that's going to move the economy away from balancing supply and demand, and it's going to bring in the politicization that creates these cycles, right? Because if it's too low, then you're going to overinvest and have a boom. If it's too high, you're not going to have enough economic growth. And it's not that they're necessarily going to get it wrong. It's just very difficult to know what that kind of sweet spot should be, that equilibrium value. I think there's a slight difference here between arguing that the money supply should be fixed or arguing that it should be free. And that's a whole other debate. But it's not necessarily the case that we would have a completely fixed money supply. It's possible that banks are essentially extending the money supply and retracting it based on what they consider to be prudence coupled with the demand for money. So you wouldn't necessarily get a completely fixed money supply. However, it's a well-taken point that there is that benefit of we shouldn't ignore nominal rigidities, I'd put it that way.